So now it's time to look at you and your money. Today we take a look at whether the dollar and US Treasury bills are really a safe place to put your money. If you have any questions for our guests, send them in. strictlymoney@cnbc.com. Joining us now is Marco Pietropoli, wealth management expert and financial advisor at RM Wealth Management. Paul, of course, is still with us as well. Marco, nice to see you.
Good morning.
We just saw it's interesting. A lot of people actually do trade currencies anyway. What's your view of sterling against the dollar here?
Well, it's difficult to see which
we've been range bound.
whether we're more buggered than the Americans. It's difficult to see moving forward. If you look at it in terms of the overall debt levels, us and the Americans have by far the biggest per capita debt in the world, and therefore moving forward it's difficult to see how one is necessarily going to fare better than the other.
And one has to remember it is a battle of the uglies as far as currencies are concerned.
Yes, who's performing the worst?
Yeah.
And that's the there's no real shining light between the two.
What about all those investors who shielded themselves in government debt markets, be it gilts or treasuries?
Yes.
What should they be doing now?
Running away as quickly as possible. Anything with a fixed coupon is clearly negatively correlated with interest rates. But of course most investors don't actually buy the pieces of paper. Now if you buy the pieces of paper, there is an implicit guarantee there that you will get paid back, and worst case scenario, a government can always print money to pay you back. So there is a certain amount of guarantee, but that's not how investors actually access the investments in the main. They'll do it through funds. And unless you actually hold the actual piece of paper through to maturity, there's no protection to your capital there. And therefore the protection to your capital, if it's not there, is not the basis for the investments in the first place. So if you're looking at US Treasury bills, you've got risk to the dollar staying weak. You've got significant risks of interest rates going up fairly sharply. Now, if you're trading on a short-term basis and you can get it right, so when the equity markets sell off, you're one of the first people to get into US Treasury bills and you get the upswing with that, then brilliant. But if you're looking for something which is a safe haven to put your money for the next 5-10 years as an investment that you don't worry about too much and it sort of ticks over, that isn't the place to be.
Go along with it.
Pretty much. I think you've got to start out with your view about inflation and deflation to kick off with, because what has been clear from central authorities has been their commitment to retaining this very low interest rate environment. But what we do know is that this stimulus is going to find its way out some way at some point.
It's not happening yet, though, is it?
It's not happening yet, and it's not likely to, because we still have this major issue of banks still undercapitalised, still having to repair the balance sheets at the moment. They've still got a huge amount of refinancings to perform over the next few years with corporate America, corporate Britain. That's going to be their prime focus at the moment, and therefore demand for new lending is not necessarily there to drive the asset growth which drives the inflation. So I still remain in the camp that inflation does remain subdued in that environment, so I'm not too concerned, but I very much go along with the principle at the moment that these fixed asset investments are risky if you're taking short-term views and playing particular scenarios.
So Marco, what do you do then at the moment if you're looking for that secure investment?
Well, as I keep saying to a lot of people, if I gave you only two choices of investments for the next 10 years, and I said, look, here there is a US Treasury bill. It's yielding 3.6% fixed. You've got risk to capital, with the dollar going potentially weakening, and with interest rates going up over that period of time. Or I've got a barrel of oil over here at $63 a barrel. Which one would you do?
Why do I only have two choices?
Well, no. This is the point is the point is that over that sort of length period of time, it's not a safe place to be. Good place to be, I think, are index-linked bonds. Inflation is going to return. I don't buy this deflation argument. I've never bought into it. I thought there was going to be deflation in the short term because of excess inventories and excess production, but that has largely been scaled back. And the risk moving forward is very much another spike in commodity prices based on the weakening of the dollar.
Yeah, commodities are, I mean, right now, resource stocks are the ultimate I mean, they're the ultimate sort of risk bronze, aren't they? On the down day, they're down, and on the up day, they're the best performer.
Absolutely, and I've said this before. If you buy it, it's a great proxy for that particular trade. China is booming. It is an economy that they've re-stimulated. The growth numbers are quite undeniable at the moment, and they're absorbing these type of assets. The problem for the domestic market here in the UK is that we're going to import inflation. We're going to import the wrong type of inflation because we don't have the type of income growth from our manufacturing base to accommodate this over time. So we may end up in a situation where rates have to go up to accommodate inflation, but we haven't got rid of the debt burden. That's why I still remain negative to a localised market here in the UK and largely to the Western world at the moment, because I think the distortions that China will bring over the next few years, as I say, could have some pretty negative ramifications for us.
Do you know, you mentioned, I just want to bring this out, I was reading something today from Capital Economics, and they said one government researcher in China suggests that a fifth of lending, the fifth of bank lending in the first 5 months of the year ended up being used to buy shares in China. Kind of scary, isn't it?
Yes, we do it over here. They're called CFDs.
Well, I suppose they do. Yeah. Marco, final word from you.
Well, I think one of the biggest risks moving forward is the demise of the dollar. It's something that no one wants to talk about. It's talked about in the financial press, but not really talked about in the mainstream press. China's been pressing for a new global financial structure for a few months. We will see it at some point. The question is when, and will it be a smooth transition, or will it be chaos until we work out a new system?
Okay, Marco, good to see you today. Thanks very much indeed for joining us. Marco Pietropoli, wealth management and expert and financial advisor at RM Wealth Management. Paul, we'll let you go as well. Thank you very much. Paul Kavanagh from Killick & Co.